Welcome everybody to the Thursday edition of the Not Your Average Investor Show, where today we're going to talk to Lee Bishop, who's a JWB client that's been investing for a couple of years, but despite the rise in home prices in Jacksonville over the last year or so of 12%, he's looking to re-up. We are officially live on Thursday for the Thursday edition of the Not Your Average Investor Show. Today we're doing something different. It's the JWB Rental Property Investor of the Week. I'm your host, Pablo Gonzalez, and with me today, we're doing something new. We got the man they call LB because he loves to lend his brain. He loves Baltimore, and he's the little brother of the Not Your Average Investor Show, and because his name is Lee Bishop. Welcome, Lee.
Thank you, Pablo. That's a great introduction. I love it. That's wonderful.
I wanted to surprise you with that one, buddy. You deserve it. You deserve it. You deserve it. All right. So welcome, everybody. We already got a bunch of our regulars in the house. Carl Thompson, good morning to you. Nadeem, good to have you back. Dean Curry from Columbus, Ohio. Good to see you. And like we said, we're doing something a little bit different today, right? Normally, Thursdays is the property of the week. We're very happy for Greg, who is on his way to Pebble Beach to play a little bit of golf. And we thought, how can we add some value to the community? But to have Lee Bishop on, who, as we said a little while earlier, been investing with us for a while. He's the MVP of the Not Your Average Investor Show. And he is right now looking at a property. He's looking to re-up his, add more to his portfolio. And we're going to get to pick your brain, Lee. You excited about it?
I am excited about it. I'm very happy to be here. It's an honor. Greg, I'm not filling Greg's shoes. I'm just helping out.
That's what I told you. Don't try to be Greg. Just be Lee. Let me, and I'll be Pablo and a little bit of Greg, right? So as you all know, we got our community in the house already. Lewis Carlson, good to see you, Lewis. Lou Carlson, good to see you again, my friend. Those of you that join us all the time know that there is two ways to communicate here. We want you asking questions. We want you interacting with Lee and with me and Lee. I think we're going to make a song about that one. Two ways to do that. Number one is the chat, right? And there's a little trick to the chat that our regulars know. It's that when you first pop open that chat, it's only defaulted to talk to the panelists. Only Lee and I will see it. And if you want everybody else to see it, which I recommend, Scott below, welcome, Scott. If you want everybody else to see it, you got to change that blue box right above where you type to panelists and attendees. And that way you can make a friend. Normally you're going to automatically make a friend with Lee, but now he's the star of the show. So there's other people will have to carry that heavy mantle of Lee in the chat. And then second is the Q&A box, right? If you're able to go to the bottom right of the screen, you pop open the Q&A box. That's the best way to get it on the screen for me to see it so that I can ask Lee during the show and we can pontificate about it during the show. So little caveat, I'm not a real estate expert. I just play one on TV. Lee is an avid real estate studier, right? But he's not representing JWB. He is representing the voice of the client. He's representing himself, right? So any kind of technical question that you have that you want from JWB answered, Robert Weisner, good to see you from Marietta, Georgia, just down the street from us here in Jacksonville. Anything that you want answered, that's a real technical question, a JWB thing that I can't answer very easily, just put it in the Q&A. The sales team will reach out to you, right? So not even a sales team, right? Customer success, right? Like Courtney, who is super, super helpful. She'll reach out to you and get your question answered. But most importantly is the best place to ask questions whenever you want is our Facebook group. If you go to jwbfacebookgroup.com, Miguel Angel Sanudo, tuning in from Spain. Welcome back, Miguel Angel. Good to have you, man. If you want to hang out with us throughout the week, we got a Facebook group that has almost 2,800 people in it, all sophisticated real estate investors, all generous people that are sharing knowledge. So that's really the best place to hang out. If you can hang out and go to jwbfacebookgroup.com, opt in. We'd love to see you in there. And if you're already in there and you're already getting value, we have this goal to get to 3,000 people by the end of the quarter. So if you can invite a couple of your friends, that'd be great, right? We're in there. We're here to serve. So you'll see it's a good time. Without further ado, Lee, man, I just, it's a mouthful. It's a mouthful to get all that out there, buddy.
Pour me out.
Huh? Yeah, right. Leo's in the house from California. Welcome. Good morning, Leo. Lee, I want to start this off, right? Before we get to the property that we're going to break down, right? This is the rental investor of the week. So it's about you. So it's about you. Why don't we catch everybody up who has If you've never been to a Not Your Average Investor show call, you may not know who Lee is. If you've ever been to one, you know who Lee is. He's at all of them, and we always talk to him. But for those of you, for the 2 people on the internet that don't know who you are, why don't you tell us, Lee, how did you get it started in this asset class? How did you go about it? I know that it's a family decision that you did this. Why don't you tell us a little bit about how you got started?
Yeah, that's great. I love to. So I joined Fortune Builders in 2018 when I retired from my IT job, and my wife said, "You're not retiring. You're too young." So she said, "Let's do real estate." And I said, "What the hell? I'm not swinging a hammer. It's 50 feet." And she said, "No, let's see what Fortune Builders has to say." So I joined their educational program, and while I was learning how to be a real estate investor, they had an entire episode on asset protection, and I thought that was fantastic. And they said, join the passive income club. So I was a member, so I joined the passive income club, and Mike over there introduced me to Mike Stetson of JWB, and they had a couple other investors that they were working with, and I vetted with JWB, talked to them, talked to everybody, and had a best feeling about JWB. I was talking to Mike Stetson. He did a great job selling. And so I told him what I wanted to do. And I said, I have about $1 million in investments. I have them all in the stock market. My buddy is running my portfolio. He said, this is a great time, and let me know how that works for you. So I took a $500,000 out and I put it into, I started a solo 401k LLC, and I put the money into that. So now I don't own anything. I have signature authority over it, which is the best way to be, according to Warren Beatty. Don't own anything but control everything. And so I have the 5. I went into it with, okay, this is what I have to spend. And JWB worked with me with finding houses that I thought would work. They were all new. I was kind of skeptical about working with refurbished home. Not that there's anything wrong with it. I just wanted to work with new, so I didn't have to worry about anything for the first 10 years. And my wife was like, yeah, okay, so how are we going to do it? Do I have money in it? Do you have money in it? I said, well, I'll put money in it, but you and I are going to talk about it. And we have it set up so that she can add money in the future once she sees how this is going, and we see it's going well. That's why we said, let's get another property. But so I bought 5 properties I bought the first one with cash in Thanksgiving week in 2019. I was in Pennsylvania visiting my sister-in-law, and the girl showed up at the door, to sign all the papers and everything. And then I said, okay, let's see what we can do with the other 4. And I said I wanted to keep some reserve. If I'd have paid 50%, my reserves would have been down to 0. So I talked with a couple of investors that JWB, sponsors, and they said, Bob Cash came on and he said, we can do 40% if you want, and this is the rate and whatever. So I was able to come up with that, and I had like 25,000 in closing costs, 408,000 in spending on the houses, and so I had a pretty healthy, nest egg in that retirement account that I could use in reserves. I really wasn't sure. And then COVID hit, and I was like, oh my God, thank God I got these reserves, because I was going to start doing the C3X thing and, pay it down in 8 years. And it ended up being, let's wait and see. My wife and I are saying, let's wait and see what's going on with rent. And I was thoroughly surprised and tickled that every month my rent was paid in full, or mostly in full. And at the end of the year, I was paid in full. So I had the 5 properties. I had this nest egg that's like 70, 80,000. And I said, I wonder what I can get for that. So I started talking to JWB again. And I said, so the wife was like, we felt like we were lied to all our lives. I don't know how you were told when you were growing up, but it's always like work, save. And then in retirement, you spend. Well, she said she didn't want to be the retirement payout cop role. She didn't want to say, no, you can't go on that trip. No, you can't buy that fancy car. And so, when we were talking about having this investment nest egg and not have it dwindle down, that became a no-brainer. The cash flow was, right in the money. We were looking at what we wanted to have every month to be able to retire comfortably. She's got her own portfolio. she went into a different direction where she was getting these monthly payout things from the retirement community, and watch it dwindle down, and it's gone and whatever. And she was like, this isn't going to work for me. I don't want to do that. So I was like, yeah, we were lied to our lives. We found out when we were 60-ish that there's a better way to do it. So that's how we got into this asset class. And it's been a spectacular ride ever since. I mean, it's only been a couple of years, but it really has been a no-brainer for me. And anybody that talks to me about it, I say, it's a no-brainer. You should jump in with both feet.
Yeah. I mean, sounds like a heck of a ride, right? Like, I can definitely empathize with the whole feel like I've been being lied to. And I wish that I would have been a part of this community sooner, so that so many people like you and Margaret and Jen would have gotten me to read Rich Dad, Poor Dad sooner. Right. But it's, they say the best time to plant a tree is 100 years ago, and the next best time is right now. Right. So it's kind of how I see it. So let's talk about these trees that you got planted here, Lee. Let's go over your actual investments right now. And let's kind of talk about what was your thinking behind each one? Did it, like, how did you get to buying these 5 properties? Like, what were you considering when you were looking at them?
Honestly, they say make a plan and stick to the plan. My wife and I didn't really have a plan. We talked about generalities, and I really relied on JWB to put together a list of homes for me. And to be honest with you, when I told them I wanted to buy one with cash and see how that goes, and that went smooth, I said, what do you have? And they said, how many do you want to buy? And I said, 4. So they showed me these next 4 properties. They were available. They were all in the same price class. And I was like, yeah, well, let's just do those. And at the time, they had just started doing the virtual tours. So they had some properties that were available that I could virtual tour and see a similar house. So you can say I bought it sight unseen, but I really toured the area. And so in February, when we came down there, we were looking at the houses. We drove around before we got the tour and looked at all the houses, and I standing in front of the house going like this, and it was a lot of fun, But I really, I was relying on JWB to give me houses that were new. They kind of kept it all the same. They're all the same look and feel. They're pretty distinct in how a JWB house looks. So there wasn't any guesswork. It was just fun. It really was a good ride. Easy. It was a very smooth operation in purchasing the houses.
Cool. Yeah, it sounds like you are reflecting that ideology that we kind of talk about on the show often, that these are just kind of widgets, right? Like, it's not, don't overthink it. It's you're buying the return and the profile and the risk profile. And if you can trust the risk profile and the return profile, then it's not really about the individual property. It's about the ease of use and the experience that you have when you're doing it, right?
Yeah, exactly. It was a widget. I called it a widget. So I really did think that, as long as it's generating income and cash flow, and not even really concerned about that, as long as I wasn't costing me money. So that was the other thing I was afraid of until I saw how it all worked out. Like, there were some properties where they sent, I got an email in the beginning of the month saying, oh, you got the rent collected for that. And then a couple of weeks later, I got a letter saying the same house paid again. And I said, what's going on with that? I talked to the portfolio manager, who is now Sarah Lopez, which I love. And so I had to call and say, what the heck is going on? Why did I get these 2 notices? And they said, we can't not send you one. Once the payment is in, if the check bounces or whatever happens, it goes back in, and then I get paid on the 15th, and it goes in. So they, it was a learning experience. It's all a learning experience,
Yeah.
And nobody's an expert out of the gate, I guess, except Greg, maybe.
We'll see. Greg Stone says, hello, I joined a little late. Who's talking? All right, Greg, if you've never heard of Lee Bishop, this is Lee Bishop here. We call him the MVP of the community. He's one of the most active members of the Not Your Average Investor community. He's also an active investor in JWB, who has, like you can see here on the screen, 5 properties. And he is looking to purchase his 6th right now. So we're just going through the mentality of his experience and why he's buying a 6th property. even after prices have gone up 12% since his first property. So I hope that answers. That's not Greg Cohen. I'm not Greg Cohen. Greg is on his way to Pebble Beach for an epic golfing weekend, right? So we wish him well, and we're trying to add as much value here as we can. So feel free to pick his brain as much as you want from the consumer, the client experience, and we will answer those. And to that fact, Justin Lemon already has a great question here. Justin asks, are you still at 7.5% interest for each property, or did you refinance this past year?
I did not refinance. I'm at 7.75, 7.5 on all of those houses. It was a different amount for the house that I was looking at coming up, which didn't surprise me.
Got it. Have you thought about refinancing, Lee? What's the downside to that?
You know, I don't think I have it long enough to really, I did a valuation. I get a valuation sheet every year from them so I can turn into the IRS or, to let them know what my portfolio is. And it hasn't changed that much. I mean, I had two houses that were 160 and a couple that were just under 160, but there's the valuation. It grew into the house after one full year and a half really of investing hasn't been enough to say, the cost justifies the mean. There wouldn't be really much that I could cash out. I'm going to wait 10 years like the other guy did on the show a couple of weeks ago before I do a cash out refinance and start investing in more homes that way. But as far as the reserves that I have, I'm building up to buy another house. So that's where we are.
Okay, that makes sense. And Tara Paget, great question, Tara. You're keeping me in line here. She asks, I haven't heard the why about buying when the market is 12% up. Lee, do you want to kind of share why you still think it's a good investment, even though the market's 12% up, and why you're looking to get into more?
Yeah, that's a great question. I actually, Greg inspired me. He said, in a couple of years, you're going to be saying, "Boy, I wish I bought the houses, more houses when it was low." Well, I did get them when they were low. I got to 5 when they were low. And when I saw that I had money in reserves, I thought, well, let's kick the wheels and see what we can do. See if we can generate another cog, another way to generate more income. So my why really was, I really wanted to start getting more. My end goal was to get 20. Sounds like a lot to some people, but for somebody who's just involved in getting started with my portfolio before I add my wife's portfolio to it, this was a good way to keep the cogs going, keep the money rolling, keep the cash flow going. And so my why is actually, I'm afraid to invest in the future because, I mean, not really afraid, but I don't want to put it off. That's the real deal. I want to do it now. I want to get the money. I want to get the cogs generating money now so that I can pay them down with the 3CX in 8 years or something. I put the plug in and the money on that calculator to see what would come out. And if nothing changes, if the cash flow doesn't change, if I'm not really planning on changing the rent, so I'm not building that in, but all those homes will be paid for in 8 years.
Okay. Interesting, man. So then to expand on that a little bit,
Mm-hmm.
I'm hearing you believe that prices are going to continue to go up. So even though it's up 12% right now, you still think that buying today is a better deal than buying tomorrow. And B, I'm hearing that you are planning on executing on the C3X, which we're going to have a show about later down the line, but maybe you can expand on what that is and why it's important to buy early in order to execute on the C3X.
Right. So the more cogs you have in the wheel, the reason why I paid cash for the first one was because once you take out the management fees and once I set out aside for insurance and taxes for a year, all the rest of that is pure profit. Well, if I'm not ready to use that profit yet, you take that money and you put it toward property number 2. And you're putting the extra money that you get from 2, 3, 4, and 5 back into property number 2. And that gets paid for in about 4 years. And then the next property, because you have the whole of all of, property 1 and property 2 cash flow coming in, plus the extra from 3, 4, and 5, you're paying down the third one, and that pays down in about 2 years. And then every one after that pays down in a year or 6 months. Once I get 5 paid for, it's paid for every 6 months. So I can buy a new house. I'll be able to have that asset and be able to invest more, which is my goal for doing that. 8 years, is if nothing changes. If it's cash money now, and nothing changes, all of those houses will be paid for in 8 years. So I'm really looking at generating 20. Once I get to a point where I have 20 coming in, that's my ultimate goal. And I'm hoping to supplement that with the fix and flip business that I got in Baltimore. But so far, with everything going on, I haven't been successful at all in that. So I'm kind of relying on what I have in reserves to generate cog number 6. That's where it's going on.
Okay, that makes sense. So that C3X model, we're going to have a show about that. We actually just confirmed Paul Shively is going to come back on from Fortune Builders, and he's going to go through the C3X model on a future show. Thanks to your suggestion, Lee, right? Like you're the one that asked for it, and they asked for it in the group as well. So another reason to be part of the Facebook group, right? Like you can add in really great suggestions, and we listen, right? We're here to serve. So we're definitely going to talk about that. We got some questions here on your portfolio, Lee.
Okay.
I want to hit these, but real quick, since I know that some people only have a half an hour, I do want to get into a property to just kind of look at a property that you were recently looking at, right? Like
Right.
let's talk about how you were analyzing it and what you're looking for. So now that we have your why, we also know your how, right? So sharing right now, this is for our friend that's listening to the podcast in a week when it comes out in their ear. We are magically whisked away here to 8017 India Avenue. That's Jacksonville, Florida, 32211. Purchase price of $197,000. You got a pretty picture here of, it looks like a two-story house with a 1-car garage. It's a 3-2, a lease of $1,300 per month. And over here, this is what JWB actually sells, right? This is what the client comes for, and it's these returns, right? So we always highlight this conventional finance total monthly cash flow of $155 and this estimated conventional financing total ROI of 8.14%. Lee, when you look at these houses, you join the show every single week. When you look at this house, what's the first thing that you're looking at here?
I'm actually looking to see that it's a new build, and it's a little bit different model from what I have because I have all ranchers. But the reason why I was interested in this was the price point. I was worried that that the houses were going to start to get to be 200,000 and over, like the 250. That's what Greg was talking about, among other things. But so here's this property. It was just under 200,000, and I was like, man, that's generating good money. It's got the 3 beds, 2 bath, and then I really 1-car garage. I think I have 1.5-car garage or something like that. It's not quite wide enough for 2, but maybe it is. And so I was looking at this and I'm going, man, it's so different from what I have that it's, the return on investment was going to be marginal because I was going to be using the not conventional, the non-recourse loan. And that's what all of mine are. So I don't want to get out of that because I'm still using that money. I guess what I'm saying is I looked at this as an opportunity to still be investing and generating cash and being in it. It was still new. I knew that Greg was having problems with getting the people to certify, the inspectors to certify the houses and stuff. And I thought, man, here's another new one, and I want to jump on it. So that was really why I said, Jane, we're going to get another house. Is that okay? And she said, yeah, let's jump on it. So, we were working with JWB to see if we can get financing. And so far, everything's in the works. Not sure I'm going to get this one. Maybe it's available still.
Yeah, this one is officially still available, right? But let's talk about it. So you said you're looking at non-recourse financing, right?
That's the middle one, yeah.
So you're looking over here. So talk to me about this. We normally don't do this. We usually just go through the conventional one, right? But what does this monthly cash flow mean to you here? And then what does this ROI mean to you? Lee, talk to me about that monthly cash flow number and how you describe it to Jane if she was to ask you what does this mean?
Right. So right now, my cash flow on the properties that I have is about $110 a month on all the other ones. This one says 127. I was like, oh my God, this is generating more cash flow than what we have originally. That'll just help the cog. That'll get more money generated down the road. And then you're looking at $1,300 a month. That's more than what I'm making in any of the other houses, which I expect because the price of the house is much more. But the 087, I always look at that and I say, you know what, it really, I can't look at it as a return on investment on that because I'm putting so much money in. I mean, I was putting 40% in, not 20. like some people, right? Okay. And I wasn't putting 50% in, which would make the ROI even lower because that's more money out of my pocket, that would go into it. So I don't necessarily look at the ROI because I know that as long as it's making positive cash flow, it's not costing me, it's an overall picture of the thing, right? You look at the holistic view of everything that you're doing, and as long as it's positive cash flow for now, it's going to be cash flow in the future forever,
Yeah. So you're buying into that cash flow in retirement that allows you to make purchases that you want, right? Like kind of like instead of the save, and then spend, you are investing so that you're not just spending, you're also accruing income. And that's the way that you're looking at it. Talk to me about this 0% appreciation rate. What do you think about appreciation rate, Lee? Like when I know that I'll go through our usual kind of spiel on appreciation rate that Greg likes to give. Is the idea that they put 0% appreciation rate on the property evaluation because
Right.
in the short term, appreciation rate is speculative. In the long term, it's not. And they want you to make sure that you are holding on for a long-term appreciation if they're going to put that in. So they don't put that in there. But as we know right now, the market is appreciating higher than normal. The average appreciation rate in Jacksonville is 4.3%. And if you stick around for a full market cycle, then this is really what we think that you should be able to expect as long as you stick around for a full market cycle as little. So when you think about it, Lee, are you even thinking about this appreciation rate and it bumping up to 8% because of the 4%, or are you just strictly a cash flow investor for the future?
Well, to be honest with you, the cash flow is king, right? But if I look on return on investment, it's not, the home price appreciation, I'm looking at a long haul thing. So I'm looking at 20 years, 30 years when my son gets these properties and it's generational. His son gets that property. Whatever the price of the houses are, it's going to be pretty steady based on the value of the dollar. It's going to grow up, but it's going to be obtainable because your money is going to be, you're going to be earning enough to be able to make that living, right? So when they go to sell the house and buy more houses, that's the talk I have to have with my kids, when you sell the house, then that home price appreciation is going to come in and you're going to say, well, darn, your return on investment is way higher than what you thought it was going to be. And I said, that's the conversation for the future with the family, right? So generational. When I turn it over to my kids, I got to have this long talk with them about, home price appreciation value, the 5 profit centers, all of that is going to come into play at that point. Right now, I'm mainly just focused on cash flow. And I know in another couple of years, that's not going to be the focal point. It's going to be one of the other profit centers. And that might work for somebody that might be in it for 5 years, 10 years, something like that. But I'm really in it for the long haul. So if I keep those houses for 20 years and then sell them to buy more houses at JWB, that's a great solution too, right? So yeah, that's what I'm looking at. I'm thinking big picture down the road. So that number I don't even really pay attention to that. So I'm kind of glad that Greg keeps it at 0%, because that's not a decision factor for me.
Yeah, that makes a lot of sense, man. And that is, I think, why you jive so well with the JWB message. Like you're the ideal client that buys into the entire methodology, right? We got Margaret Smith. Seems like she's down that same path too, right? She's putting that. Margaret, your friend Margaret Lee, by the way.
My best friend, Margaret.
That's right. That says, me too, Lee. Same goals. 1, throw off a bit of cash. 2, legacy for my kids who will need to know 0 about property acquisition or management, can just keep the properties in place. And when mortgage is paid, cash flow will double. Denny Davis is writing in, besides putting a face to Lee's name, this is a great session to show there are different methodologies for different people. Some want paid for properties to max cash flow. Some want leverage for max ROI. Some want to mix the two. So many ways to skin the potato based on your objectives, your timeline, and your income, all leading to positive future outcomes. This is a great session for thinking about different methodologies. Thanks, Lee. Thank you, Denny. That's a great little comment, man.
That's great. And thank you, Leah, for saying that.
There you go, man. There you go. All right. So what else? So I feel obliged then, since we are talking about the different methodology. Well, first of all, yeah, Denny had asked in the chat, right? Will your next home be cash purchase or another finance, and why? It sounds like your next home is going to be non-recourse financing, and because you're investing in your retirement account. Anything I'm missing there?
That is very correct. Yeah, I'm still using my solo 401k to have all the investments, and part of the reason for that is protection. So, as you know, they always say you can't sue a retirement account. So, I mean, that's something that I was like, oh my God, you can't sue a retirement about. That's cool. So
Yeah.
I'm using a non-recourse loan. That's where my nest egg is sitting, and that's where money is going to get flowed in. You know, I'm going to flow money into that whenever I start making money in the fix and flip business. But my wife is eventually going to get into that, add money to that solo 401k, and have her own houses that she is, going to be able to collect money in retirement for. That's the ultimate goal, I think.
There you go. There you go. A bunch of people are talking about that, they're finding a lot of value. Scott Below saying it's great to hear Lee speak to a non-recourse purchase. So I think it's cool that we're talking non-recourse. We normally kind of explain it and gloss over it. Just for the sake of habit, I am going to talk about the typical purchase. What I've been through, at least, is this conventional financing total monthly cash flow, right? If you're using conventional financing where you're putting 25% down, and I've put 20% down, and there's ways to use the spreadsheet to figure that out, which you can download at jwbinventory.com. But if you're just putting 25% down, then you get this $155 in cash flow monthly and this 8.14% ROI. And that, to me, as I internalize it, that's $155 that's going into my bank account that I'm, really just putting away in order to buy another property as soon as possible, or maybe some more Tesla stock, or who knows, Bitcoin. Maybe I'll get crazy. And then
or a house to live in.
Oh yeah, you're right. I am getting worried I'm going to get priced out of the market here in Jacksonville, man. But at the end of the day, I'm putting my eggs into the asset basket as opposed to the liability basket, right? While I can. So
it's still smart debt. Buying your own house is still smart debt. So
yeah, I guess, man. For me, I live really close to the beach, and that is what I'm here for, right? One of the big reasons I came to Jacksonville is to surf. So if I can keep my rent real low and live close to the beach and still be building wealth through real estate, then, I'm going to wait. I don't really want to buy a house that I don't want to live in.
Right.
So,
or you get stuck in.
Or where I get stuck in. Correct.
Right.
And to me, I don't want to get stuck anywhere more than a 15-minute drive to the beach. Right. So that's kind of where I'm at.
Right.
So yeah. So again, this ROI, this monthly cash flow is essentially the typical monthly cash flow that's going to come in when you are doing conventional financing. And that is, typical as in not the day that you sign, and not when you have a turn, and not when there's a big weird expense, but that's the average experience every month. And then this 8.14% ROI is the risk-adjusted total return when you're including debt pay down, when you're including tax breaks, right? I'm not describing this as well as Greg, and the cash flow, and you're taking out all these other costs like insurance and all these other things here, right? And then when I think of the appreciation rate, I'm going to buy and hold for a long time. So I'm thinking of it as something that in 20 years, 30 years, this is the return that I'm going to be getting out of it, right? So I'm going to go back to the Q&A now, Lee, because there's a bunch of Q&A about your existing portfolio, and we'll go and we'll go through, right? So Andrew Barnhill, when we saw your existing portfolio, he had asked, why didn't you use conventional financing?
Okay, so if you're using retirement money, you can only get a non-recourse loan. And I mean, I could have, I guess, used my own cash, but I wanted it to be a retirement account and continue to be a retirement account. So I took it out of my regular traditional 401k and put it into a solo 401k. And that's why everything has to go either cash or non-recourse. That's the bottom line.
There you go. Next question. So, Raja Bantu added some perspective because people were asking about it. He bought both. He bought with his retirement account, so interest rates are high, right? Like we're looking at these 7.5% interest rates are definitely higher than what people are used to in conventional financing. And Dean Curry puts these are non-recourse loans, so the 7.5% is that type of loan. There isn't and hasn't been a cheaper option that I know of. They can't do conventional loans on an NR product. You want to kind of comment on that of the cost of these loans and the non-recourse process?
Yeah, I mean, so realistically, you're not necessarily hung up on the interest rate if you're going to be paying it down. If you're just going to be, if I was 20 and I was investing in these homes and I had 30 years, maybe I'd be doing conventional loans and not try and pay it down. I know there's a logic to having a 3% loan for 30 or 40 years, right? Just keep getting loans against it. A home improvement. I mean, what do you call it? What am I thinking of? Home finance.
HELOC.
Yeah, HELOC. Right. That's it. Yeah. Thank you, Pablo. I mean, there is something to be said for that. I'm not. Thanks, Andrew. HELOC.
Home equity line of credit, HELOC. That took me a couple of episodes to get to. Yeah.
So I mean, I'm not so hung up on 7.5% because I know I'm not going to be having a 20-year mortgage on this thing. I'm going to pay it down as fast as I can so that I can get, have more loans available to me, based on what I have in this portfolio. That's the big thing that we're doing.
Makes a lot of sense. And then Nadeem asks, and I think maybe this is answering it, but like he asked, why not buy your first property all cash? Lee,
I did.
Okay. Yeah, Lee,
I did pay cash for the
no,
first property.
I'm just reading it wrong because
Okay.
I actually just spilled a bunch of water on myself on that last cup of water, so I'm like, oh, I had an accident. So Nadeem asks, Lee, what was the reason to buy your first property all cash and not put down 25%? So I guess 25% wouldn't have been an option because it's non-recourse, but you bought your first one all cash because?
I paid cash for the first one because I wanted to have extra cash flow flowing into the COGS to pay off the next mortgage fast. That was the whole deal. Everything is all about, I'm 59. I'm going to be, retiring in a couple of years, and I'm going to want to have cash flow in my retirement. And these are the numbers that I'm going to be using so that I don't erode my initial investment, my principal interest, my principal investment, and paying cash was I had it, right? So if I would have paid cash for 3 houses, would I have had, $500,000 wasted? I don't know. I was trying to utilize as much as I could with the money that I had to gain as many, properties as I could in my portfolio. That's what the deal was. That's how it worked out. I paid cash for the most expensive one and then recourse for the rest.
Makes sense. So you're paying cash to maximize cash flow to then get to pay down on other ones quicker to increase your amount to be able to have leverage and more cash flow.
Right.
You're a smart man, Lee. You're a smart man. All right. So Vincent Gomez asks, I may have missed it, but how is Lee doing a 40% down on a non-recourse loan? I had to put down 50%. You want to talk about that?
Yes. So because I was buying 4 houses at the same time, they worked it out that since I had one that I paid cash for, they looked at all of the, my portfolio, right, as one big piece. And that's how they were able to come up with that financing. But it's not unheard of for some of the lenders to work at 40% as long as the numbers are working, right? So I was asking to put down 40% on this new property, and they said, no, we need you to come up with 50%. So whatever their formula is going to dictate how much you have to put down originally. Got
it. All right. Another question. Greg Stone has a question. Greg is a great name for this show, by the way, Greg Stone.
Greg Stone.
Greg Stone has a question. Are you using REPTs? And I'm going to follow that question asking for a friend. What is an REPT?
I'm going to look up REPT. I don't know.
Okay. All right. There you go. Greg, you want to spell that out for us, what the REPT is, and we'll come back to the question. So then that means we get to your best friend, Lee. Margaret Smith asks, Lee's charts show amount invested to acquire. Does that include, let me pop it up right here while we're talking about it. Does that include closing costs, fees, appraisal, surveys, tenant placement fee, whatever? If not, what is not included in this? Where is it? Amount invested to acquire. Where is that? I guess it's.
I think it's the last column. Total amount investment.
Yeah.
So you see that I actually put down 62,000, but with closing costs and everything, it really showed up as 68,000. So the whole thing total was I paid 1,500 in my first closing costs. I mean, for the closing costs for the first one, because I didn't have to put in taxes, because I didn't have to put in insurance. And then the next one came down that, if you subtract 62 from 68, you're going to see that's what the closing cost was. So they do incorporate that total number. The whole thing came out to about 25,000, once I was all finished. for the 4 houses for buying all the houses. Closing cost total was about $25,000.
Okay, there you go. So we got it. REPTs are real estate private trust. So Greg Stone wants to know, are you using a real estate private trust?
No, land trust, real estate private trust. No, I'm not using any of that. The protection that I have is actually built into the solo 401k, and that corporation is in Nevada. So I got 2 layers of the onion protecting me. If I were buying a regular conventional loan, maybe I would put it in an LLC in Nevada. Maybe I would put it in a land trust. I did think about that at one point, but I think that's overkill in a retirement account. Not to spend the money, for it. So none of them are.
All right, cool. I'm just taking a little notes here so I can track this stuff later. And Raja Bantu asks, they are used. Oh, he doesn't ask. He is explaining as well on the REPT tip here. Raja says they are used for asset protection as the properties are in retirement account. There is no need for REPT. So kind of the same thing Lee just said.
We're on the same page, right?
Lee, I had a question for you of something you said before. You talked about how you bought this property here, November 2019, and because everything went so smoothly, you went in and quadrupled down and bought 4 more. What do you mean by it went so smoothly, right? I feel like going smoothly could be multiple things. Like some people think going smoothly is I've been a client for 10 years and that's smooth, but it seems like for you, it got smooth for you within 30 days because you immediately went in and bought some more properties.
Right. So when I'm saying smooth, I'm saying the whole transaction went flawlessly. There wasn't any issues. There wasn't any hiccups. JWB managed to get everything, all the stars aligned. I didn't have anything to do with it. They really just held my hand and said, this is the way we're going to go. And it was so easy. So when I was able to talk to my wife about, let's get 4 more, she said, slow down, Trigger, right? Like, who buys 4 houses? And I said, I'm going to, so yeah. She got on board really quickly. And then she got really comfortable when we came down there for a visit and met the team. But she didn't have the talking to the people that I did. So I had the interaction with the JWB, customer service staff. They were wonderful. They were fantastic. They had these closing documents already set up. I was clicking on the thing, yeah, happy wife, happy life. That's right. But I mean, honestly, it really was an easy process. So I can't complain at all. I mean, I honestly rave about how smooth it went.
All right. Yeah. We are familiar with how much you rave about buying with JWB. We appreciate that. So going back to Greg Stone's question. So Greg writes now in the Q&A, thanks. Then I guess since I didn't buy in a retirement account, I should look for the protection. So Greg, what I can tell you is that when, number one, the best way for you to hash that out is go to chatwithjwb.com, hop on a call with the team. They will be more than happy to talk you through the different levels of protection that you can acquire at whatever cost you want. I would highly recommend that you do that. Outside of that, number two, I can tell you is that I know that when Greg Cohen is on here on these calls, he talks about the idea that often insurance is more than enough to protect you for asset protection, right? So they have really, really skilled insurance teammates at JWB, and that might be an option. And then number three, I would also just tell you to go to the Facebook group, right? Put the question in there in the Facebook group, because a lot of people, just like right now, you're hearing Lee give his take on a bunch of things. You're going to get a bunch of different takes on how people are protecting theirs based on their exact risk portfolio that they want. And I think it's reflected here in the chat, right? Like Denny Davies, who's been a client for a long time. He puts $2 million umbrella insurance for 10-ish or less homes might be enough coverage for conventional versus added protection of LLC. Had an interesting conversation with Greg about this back in the day, meaning Greg Cohen, not you, Greg Stone, unless something weird's happening right now. And Andrew Barnhill also writes, I've had an umbrella for years. I just need to get this property attached to my existing umbrella, right? So there's multiple ways. I think somebody said to skin the potato. I've never used that before, but there's multiple ways to skin this potato in the way that you protect. So if you want the expert advice of the team, go to chatwithjwb.com. It'll be really easy. If you want the wisdom of the crowd, go to jwbfacebookgroup.com. And I'm sure you're going to get some really, really good advice. So here we go. Leo from California. He writes,
hey, Leo.
Hi, Lee. do you happen to use or utilize bonus depreciation for all your rental properties?
Bonus appreciation. No, I didn't. Actually, I had cash in regular traditional stocks and bonds, not bonds, stocks, and sold those and put the money into an escrow account and transferred it into my solo 401k account. I did not. I know what you're talking about. I did not utilize that at this point.
Can you, let's say I have a friend who doesn't really understand what bonus depreciation is. Can you explain it to my friend on what you know about it? Because my friend doesn't know.
Your friend doesn't know. So if I were to sell my house and or do have cash available from my house and sell it to somebody, you can get more than 60% of your value of your house to do that. There was a guy when I talked about that from California. And he did that. He had the money. He was on the show, and that's where he got his money to get started. Yeah, yeah. So I did not do that. No, this house is paid for. This is my wife's new dream home. Because it's paid for. So.
All right. I'll admit it. It's me. It's not a friend. I didn't know what bonus appreciation is. I'm just gonna come clean here, guys. All right. Rick Williams. Good to have you on board, Rick. I don't think I've seen your name here before. So hope you join us more.
He was one of the guys that talked to me about it. Was a referral from JWB to talk to me. Yeah.
There you go. Rick Williams. All right. Hey, got the name of a really great Dolphin player one time that retired on us. But all right. So is it possible for a W-2 employee to have a solo 401k?
Yes, it is, as long as you do have money set aside for retirement that's not in your company. If you're in a 401k that is company controlled, whereas you don't have any say as to where it goes, none of the guys from Wells Fargo or any of those guys that are doing investments are able to sell houses. So that is not something that they can do for you. So if you do have money that's outside of a retirement account that you want to put into a retirement account, you can certainly do that like I did. I mean, I cashed out mine, but in order for me not to get penalized and extra taxes and that kind of stuff, I had to put it into an escrow account so that there was a cash trail. Yeah.
Interesting. I've learned something new there. So Rick, if you want some introductions to people that can do that for you, chat with JWB.com or JWBFacebookgroup.com, right? Like depending on how much you want to interact, right? Like we got both ways. You can ask people like Lee or you can ask the team themselves. Lee, this has been awesome, man. I think you've been nailing it, buddy. Like I feel like we've got rave reviews. We've had amazing contributions from the chat in here. Like this is, I'm gonna refer to this as the wisdom of the crowd episode because it's been awesome.
This group is great for talking about properties with their wisdom. I love being a part of it.
It's been really, really cool, man. I'm not gonna lie, I was a little nervous with GC not being here, right?
He's still not being replaced, damn it.
Yeah.
We need the GC.
Yeah, well, I mean, listen, I still want him around, man. He is my crutch. But this has been awesome, man. I really appreciate everybody's input. This has been really, really good. I don't see any more questions rolling in, so no need to stay on longer unless you got anything else bubbling off the top of your dome, Lee, that we should talk about here that you want to share with people. No pressure. Don't need to have one. All right, cool. So
no, we're good.
Yeah,
you've been fantastic, Pablo. You're a fantastic host.
I appreciate it, man. I appreciate it. So listen, Greg is still in Pebble Beach through next Tuesday. And next Tuesday's call will be with Alex Safakis. So he's the other co-founder of JWB. He was Greg's roommate from college that talked him into dropping out of Johnson & Johnson to start this company. And he's also the visionary of the company, right? He's the guy that makes the big dreams kind of like come to reality. And he's going to be talking about the biggest sources of opportunity coming down the pipe in Jacksonville in the near term here. And we're going to get into that. It's going to be a lot of fun. And yeah, Denny Davis writes it. He puts it in the chat. Oh boy, never know what you're going to get with Alex. That's a fact, Denny. I call him the Tasmanian devil of real estate because you never know. Right. Oh, we got one more question here. Raja Bantu asks, with the non-recourse loans, did you pay any points?
No, there were no points, but there is a $15 a month charge to have that loan with Bob Cash. That's what's going on. That instead of in lieu of paying points up front, And I thought that was better. There was another investment company at JWB has that does ask for, I think it's 1.4 points. I think it's 1 point, but your portfolio manager or chat with JWB, they'll be able to tell you what is really going on.
Got it. Yeah. So portfolio manager, talk to, if you're a client, you have a portfolio manager, that's your best form of contact. If you're not a client and you want the treatment of a portfolio manager, chat with jwb.com. A couple more questions rolling in, Lee, since we got a little time. Anthony Ditta asks, quick question, Lee, do you have your homes under an LLC?
They're under a solo 401k LLC. So yes, it is a LLC in Nevada, and I have signature authority over that, but I do not own the homes. The company does. The LLC does.
There you go. Can you talk about why you did that, what you were thinking about, like, how you pulled that off?
Yeah, I learned that as part of the asset protection program that I talked about that Fortune Builders put on. They do a great job of protecting your assets and how you can grow wealth through passive management. And so they led me all the way through the process, and it was a pretty easy process. It didn't cost a lot of money to get invested in that, to start that kind of thing. But I will say that if I were to try and do that on my own, I wouldn't have had any idea how to start that. I would not have known any of this. I mean, honestly, I'm a voracious learner, and I love learning. And every week I learn something off of this show. And I thank Greg for that all the time. I mean, I really get nuggets every week. But that stuff, I learned that from being in an investment group that teaches. That's what Fortune Builders does. So yeah, LLC, that was the reason I did that. Asset management, asset protection, everything was about that.
Great. All right. Margaret Smith asks, any refi possible with non-recourse loans? Are you able to refi the day that you think it's worth it?
I heard two different sides of the coin on that. One of them said, oh, you can only do that if you have Fannie Mae, Freddie Mac and all that. But I as a non-recourse, I'm not falling under those categories. So I don't think that that's something that they would offer. That's why I was talking about selling the houses after 20 years and buying 2 more houses or 3 more houses, whatever I could afford after selling them. That's what I was looking at.
All right. Sounds good. Lee, we're going to wrap it up here. There's a lot of love happening for you here in the chat. Tons of value given out, man. This was really, really cool. Leo,
I love these folks on this show.
It is, right? Like, we're like a family here, man. This is it never, like I say every time, right? Like, I never take for granted the idea that people take an hour out of their busy schedule on a weekday to join us. And I really, really don't just take for granted, but I just treasure the bonds here, right? Like the fact that we have all really congealed into a community, and this feels like a group of friends getting together on a regular basis is a really, really special thing to be a part of. And Lee, you are a big part of that, man. Like without your, without you and a handful of other people that are really the ones that had the most exuberance at the beginning of the show, and when there's no questions, adding a question and befriending people and hopping on the call with stuff, man. Like you really are the glue guy here, man. So I'm really, really grateful for having you on board and for you showing up and getting to put a name to your face for everybody else that's been a part of it. So thanks, Lee. I really appreciate you doing this, buddy.
It's been my pleasure. Honestly, I love talking and listening to you guys. I laugh when I need it, and you guys make the show. You make it fun. You make it entertaining. You make it intelligent. I mean, that's what you're looking for in a podcast, and I love being a part of it. I love that I can say that I am a team member of JWB. And by that I mean they produce the houses that I'm buying and I'm renting out, so I'm helping community, and I love the fact that they will beautify a neighborhood one at a time, one house at a time, and I can be a part of that. I love that concept.
Awesome, man. I'm just like, I'm beaming from ear to ear. All right, buddy. Have a good one. I hope everybody has a great Memorial Day, right? Like, I hope you have a great long weekend, and I'll see you in the Facebook group, and I'll see you on Tuesday. Take care.